Welcome to this lesson. So in this lesson, we are going to look at accounting for capital and liabilities. So we are going to cover the following topics: capital, drawings, current liabilities, and non-current liabilities. So let us start with the first one, that is capital. So we start by defining capital. So we can define capital as resources introduced by the business owner into the business, both new and continuing business. Most people refer to capital as the money that is required to start a business. So it can be for a new business, but it can also be for a continuing business. And it can be in form of cash or asset. So capital does not have to be only cash, it can also be an asset. So this is how we record capital in accounting. Double entry for capital. Number one is capital introduced in form of cash. And we have an example here. Introducing cash from personal savings into the business. So we call this capital because the money did not come from the business. The money came from your personal cash, from your private or your personal savings account. So if the money had been obtained from the business, maybe from sales, then we don't call it capital because the money was just within the business. So these are the entries for capital introduced in form of cash. We debit cash account because you have introduced cash into the business, which was not there. So cash has increased. And then you credit capital account. So increase in capital, we always credit, whether the capital is in form of cash or in form of asset. Increase in assets, we always debit. And the cash is an example of assets. So number two, we have another type of capital, and this is capital introduced in form of asset. And here is an example: bringing a furniture from home for use in the business. So if you take a furniture from your house and you use it in your business, we also consider that to be capital. So you are going to estimate the value of that furniture, and you are going to record in your capital that you have introduced more capital. Any asset that you bring from home into your business becomes capital. So that is how we record capital introduced into a business. So next we have something known as drawings. So drawings refers to resources taken from the business by the business owner for personal use. So in other words, drawings is the opposite of capital. In capital, we have said you introduce the resources into the business, your personal resources. And now in drawings, you remove those resources from the business for your own personal use. So it is the opposite of capital. We have examples of drawings here. Taking cash from the business to pay rent for a residential home. If you are paying rent for the business premises, that is not a drawing. Instead, we call it an expense. But if you are paying rent for your residential home, and that is not where you conduct your business from, that is money taken from the business for non-business uses. So it becomes drawings. Or it can be taking money from the business to pay for school fees for your child. So that one is drawings because you spend the money for non-business uses. Another one is taking goods from the business for use at home. So for example, if you have a shop, you can take some items from shop and you take them to your home to use them at home. So that is also drawings. So when it comes to drawings, there is a principle that is normally applied. The applicable principle is called the separate entity principle. So this principle states that the business and the owner should be treated as two separate entities, which means that assets and liabilities of the business should be recorded separately from those of the owner. So the assets of the business are not the assets of the owner. The liabilities of the business are not the liabilities of the owner. So for a sole trader, we normally say that the owner and the business are one, but when it comes to the accounting part of it, the two should be separated. For example, the owner should have separate bank accounts for business and personal use. So this is the double entry for drawings. So again, drawings can be in two forms. We can have drawings in form of cash. We can also have drawings in form of asset. So if the drawings are in form of cash, then we debit drawings account, and then we credit cash account. But if the drawings are in form of asset, we debit drawings account, and then we credit assets account. So that is because the asset has reduced. And in the other case, the cash has reduced. That is why we credit. So we have an example here. This example says, the following transactions took place in Kamau's business. On March 1st, Kamau opened a business and introduced 100,000 from his personal savings as capital. On March 2nd, he brought furniture valued at 20,000 from home for use in the business. On March 15th, Kamau took goods worth 5,000 from the business for personal use. On March 30th, he took 10,000 cash from the business to pay for his residential house rent. Show how the above transactions will be recorded. So this is the solution. We are going to look at it. We are going to look at the example one date after another. So let us start with the first date. That is March 1st. Kamau opened a business and introduced 100,000 from his personal savings as capital. So this one is very simple. Remember what we have said. Increase in the capital, we credit. Increase in the cash, we debit. So cash has increased by 100,000. Therefore, we debit cash account. At the same time, capital has increased by 100,000. So we credit capital account with 100,000. Then we go to March 2nd. He brought furniture valued at 20,000 from home for use in the business. So in this case, assets have increased. That is, furniture has increased. And at the same time, capital has also increased. So we debit the asset. We call it furniture account. So we debit furniture account with 20,000. And because capital has also increased, we credit capital account with 20,000. We go to March 15th. Kamau took goods worth 5,000 from the business for personal use. So this is drawings, and it is drawings in form of goods. So the goods have reduced and the drawings have increased. So March 15th, we debit drawings account. So we debit drawings account with 5,000. Anytime the owner withdraws cash or goods, we are supposed to debit drawings account. So we debit drawings account, and then we credit the asset that has reduced. So in this case, the asset is goods. Once we buy goods, we normally debit purchases account, or some people maintain an inventory account. So because you have reduced your purchases, you are crediting purchases account with 5,000. Then on March 30th, he took 10,000 cash from the business to pay for his residential house rent. So because this is not rent for business premises, it is also going to be treated as drawings. And it is going to be drawings in the form of cash. So here, cash has reduced. So we debit drawings account with 10,000, and then we credit cash account with 10,000. So we were supposed to show how the above transactions will be recorded, and in most cases, you are required to prepare the actual accounts. And these are not the actual accounts. This is just, we can call this one the journal entry. This is the journal entry. It just shows you which accounts have been affected and whether you are going to debit or credit those accounts. But now, if you are required to prepare the ledger accounts, this is how you are supposed to do it. The first one is capital account. Anytime capital increases, we are supposed to credit the capital account. Remember, on March 1st, Kamau had introduced cash from personal savings amounting to 100,000. So we debited the cash account, and now here we are crediting the capital account. Again, on March 2nd, Kamau introduced furniture from home into the business. So the furniture that was brought from home increases capital. So we also credit the capital account. The other entry, we debited the furniture account. So it was an increase in asset and an increase in capital. By the end of the period, Kamau will have a total capital of 100 plus 20, which is 120. Therefore, the balance carried down in the capital account is going to be 120,000. So one thing you are supposed to note is that even though we said increase in the capital we credit, decrease in the capital we debit. When the capital decreases by drawings, we do not debit the capital account. Instead, we create a drawings account and then we debit the drawings account. Drawings reduces capital, but we don't record those drawings in the capital account. They have their own account called drawings account. But in reality, drawings represents reduction in capital. Next, we have cash account. So the entries here are very clear to see, because if you go on the 1st of March in the capital account, you will see that in details column we have written cash account, and then the amount was 100,000. Therefore, when you go to the cash account, on the opposite side, the date is going to be the same as the one we have in the capital account, that is March 1st. And in the details column, you're going to write the name of the other account where the transaction was recorded, that is capital account. The amount is 100,000. Then on 30th March, Kamau took 10,000 from the business to pay for rent for residential home. So because that one is a drawing and it was a drawings in form of cash, it is going to be credited in the cash account because it has reduced cash. And at the same time, these drawings in form of cash is going to be debited in the drawings account. So the date is the same, that is March 30th. Details, we write the name of the other account, that is cash account, and the amount is 10,000. So one thing you're supposed to note, once Kamau took 10,000 and used it to pay rent for his home, we don't write here rent. We don't write here rent because that rent is not a business item. It is not a business expense. But if the rent was for business premises, we would have written here rent expense instead of drawings. So all business expenses, we just use the name of that expense. But all personal expenses, they are drawings, and we don't use the name of the expense. If you take money to pay for your child's school fees, we are not going to write here school fees as the expense. We are going to write here drawings, because any money that you take out of the business for your own personal use becomes drawings. So lastly, we have the drawings account. So on March 15th, Kamau had taken some goods from the business for personal use, and the value of those goods was 5,000. So we said, because you have reduced your inventory or your goods, you are supposed to credit purchases account, and then you debit the drawings account. And then we have already seen this one, drawings for cash, you credit cash account and you debit the drawings account. So the only account we don't have here is the furniture account, but it is just going to be as simple as the cash account. Because furniture, we have it in the capital account on the credit side. So if you open a furniture account, you are going to record on the debit side and call it capital account. So I hope the accounts are clear. Let us proceed with the next part. So now we want to see how profit affects capital. So profit increases capital and loss reduces capital. So if you are given capital at the year beginning, and then we assume the owner has not introduced any more capital in form of cash or in form of asset, so that capital will change depending on the amount of profit the business will make in the year. So capital at the year end is given by capital at the year beginning plus profit made in the year. But if the business made a loss, then you are going to deduct, because loss reduces capital. Capital at the year end will be given by capital at the year beginning less loss made in the year. In some exam questions, you may not be provided with the amount of capital, especially one of the topics called incomplete records. In some cases, you may not be given the amount of capital. So if you are not given the amount of capital, you can use this formula to find capital. So capital is equals to total assets minus total liabilities. So this one, we normally use it to find capital at the year beginning. Then once you have capital at the year beginning, you can use these equations to find capital at the year end. So once you have calculated capital and you are now preparing a statement of financial position, so this is how we record capital in the statement of financial position. The subheading is supposed to be financed by, especially if you are preparing a statement of financial position for a sole trader. So just write financed by, and then below that capital, you show the amount here. So this capital is going to be capital at the year beginning because we had not added the profit. Now after we add the profit is when you are supposed to get capital at the year end. So take the capital at the year beginning, add profit which the business made during the year, and if it is a loss, then you are going to less. So you can either add or less depending on whether it is profit or a loss. Then you less drawings. So the amount you get here is now the capital the business has as at the end of that year. So we are through with capital. Now let us look at liabilities. So how can we define liabilities? So liability refers to the amount a business owes to outsiders. Liabilities can be divided into two. We have current liabilities and we have non-current liabilities. So let us start with the current liabilities. The difference between current liabilities and non-current liabilities is the duration a business has to repay the debt. In current liability, the amount is payable within 1 year. And examples of current liabilities include credit purchases, or you can just call it accounts payable. When you buy goods from a supplier and you don't pay, they become creditors or accounts payable. We also have bank overdrafts and accrued expenses. So we are going to talk more about accrued expenses and accounts payable later. Then non-current liabilities. In this case, the amount is payable over a long period of time, usually over 1 year. In an exam question, if you come across something like a bank loan, debentures, finance lease, automatically you know that is non-current liability. So even if you are not given the duration within which the bank loan is to be repaid, so we always assume that the bank loan is a non-current liability. So let us proceed to the next part. So let us now look at accrued expenses. So what are accrued expenses? These are expenses that have not been paid within the required time, usually by the end of the year. So by the end of the year, there are those expenses that the business will not have paid, and the business was required to pay those expenses within that year. So by the end of the year, we are going to call them accrued expenses. So the services or goods have been received, but the payment has not been paid. For example, you have already used electricity for that month or for that year, but you have not paid for that electricity. So if you go to the next year without paying for the previous year's electricity expense, then it is going to be an accrued expense. So next we have income received in advance. This is income received before the period when it should be received. We have an example here. A customer paying for goods or services before the business provides the service or goods. So you receive money from a customer, but you have not provided the service. Or you receive money from a customer and you have not supplied the goods. Maybe you have not even produced those goods. So you have received income in advance. So we want to see how we are supposed to account for income received in advance and accrued expenses, both in the income statement and in the statement of financial position. So these are the accounting treatments. So we start with the income statement. Accrued expenses must be included in the profit and loss account, even if the money is not yet paid. As long as the expense belongs to that financial year, it should be included. So remember, there is a principle called the accrual principle, as well as the matching principle. We are supposed to record an expense in the financial year in which the expense was incurred. It does not matter whether the cash was paid or not. We account for expenses in the year when the expense was incurred. So that is how we treat accrued expenses. We normally add them to other expenses in the profit and loss account. And then we have income received in advance. So income received in advance is not included in the income statement because it does not belong to the current year. You have received income for next year before next year comes. So if the income is for 2026, you cannot record it in the profit and loss for 2025. And if it had been included in the 2025 income, you are supposed to eliminate it. You are supposed to deduct it. So that income will be recorded in the year when it was supposed to be received. So remember, again, we don't look at how the cash is moving in the income statement. We look at when the income is supposed to be received, not when the cash changes hands. So next, we have statement of financial position. And we start with accrued expenses. Accrued expenses are treated as current liabilities. And then income received in advance is also a current liability. Why? Because the business is liable to providing the service. You have been paid, but you have not offered the service. So it is as if you owe someone a service. You don't owe them money, you owe them a service or a product. That is why we treat income received in advance as a liability. Next, we are going to look at preparing a creditor's account, because this one is one of the main liabilities that we are going to come across in financial accounting. Number one, goods purchased on credit. So when you buy goods from suppliers and you don't pay cash, you are supposed to debit purchases account, and then you credit creditors or accounts payable account. So one thing you're supposed to remember here is that the purchases account is used to record goods only. If you purchase a different kind of asset, for example, you purchase a motor vehicle, you should not debit purchases account. Purchases account is exclusively for goods, the goods that you buy with an intention of selling them in the future. So that is how we record goods purchased on credit. And then when you pay the creditors in future, you debit creditors or accounts payable, and then you credit cash account if you have paid in form of cash. But if you have paid through bank, then you are going to credit a bank account. Number three, discount received from creditors. If you do receive discount from creditors, it means the amount you are supposed to pay them has reduced. And when the creditors reduce, we debit. So you're going to debit creditors accounts or the accounts payable, and then you credit the discount received or the profit and loss account. So let us now see the account itself. This is the format for the creditors account. Increase in creditors, we always credit. Decrease in creditors, we always debit. So you are supposed to start with the balance at the year beginning, that is called the balance brought down. Then you add the credit purchases, all credit purchases made during the year. Then on the opposite side, you are supposed to record any discount received from creditors and any payments made to creditors. So in other words, on the debit side, you record anything that reduces the creditors. And on the credit side, you record anything that increases the creditors. Then at the end of the period, calculate your balance carried down. So let us try to apply this format in a question. So here we have an example. So this example says, at the beginning of the year, the business creditors stood at 80,000. At the end of the year, the creditors were 100,000. During the year, a discount of 30,000 was received from creditors. The business paid 200,000 to creditors during the year. So prepare the creditors account to determine the amount of credit purchases in the year. So you just need to remember the format for the creditors account. So if you are given the two balances, that is the balance at the year beginning and the balance at the year end, then the balancing figure is going to be whatever has not been provided in the question. In this case, the credit purchases. So we start with the first point. At the beginning of the year, the business creditors stood at 80,000. So according to the format for creditors, that is the balance brought down, and it should be recorded on the credit side. So on the credit side, we are going to record 80,000. We go to the second point. At the end of the year, the creditors were 100,000. So 100,000, that is the balance carried down. So you go to the account, at the balance carried down, you record 100,000. Then you go to the third point. During the year, a discount of 30,000 was received from the creditors. So discount received reduces the creditors. So we have said we are supposed to debit the creditors account. So on the debit side, discount received, we record 30,000. And then the business paid, that is the last point. The business paid 200,000 to creditors during the year. Payment to creditors, we are supposed to debit payment to creditors, 200,000. So now it means that the balancing figure is going to be the missing item, that is the credit purchases. So to find the balancing figure, we need first to find the total for the debit side. So 30,000 plus 200,000 plus 100,000, that will give us 330,000. On the other side, we are supposed to have the same total, 330,000, which means the balancing figure is going to be credit purchases, and it is going to be 330,000 minus 80,000. So that is going to give us 250,000. So that is how you prepare the creditors account. If you are given everything else apart from the balance carried down, then your balancing figure should be the balance carried down. Or in short, whatever is missing becomes the balancing figure. So that is the end of this lesson. Thank you for watching. I'll see you in the next lesson.